Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today we're taking a closer look at a concerning situation unfolding in Ontario's Cottage country, where mortgage broker Sandy Sussman is facing allegations of fraud. This is a big story, Steve, because Cottage country has long been a favorite retreat for Toronto's elite, and it's shocking to hear about these fraud allegations.
Absolutely, Sandy. Cottage country is known for its picturesque vacation homes around Lake Caucasiing, and it's been a lucrative spot for real estate investment for years. Sussman was well regarded in the community for offering what seemed to be safe and profitable investment opportunities in this area. Now, however, his business has collapsed, and these allegations are casting a shadow over the local real estate market.
It's particularly alarming because the situation has drawn comparisons to Bernie Madoff's infamous Ponzi scheme. The idea that a trusted figure in the real estate market could potentially be involved in such fraudulent activities is unsettling, especially when the housing market has already been experiencing significant fluctuations.
The comparison to Madoff certainly raises eyebrows. It's important to note, though, that these are still allegations at this point. The investigation will need to run its course before any conclusions can be drawn. What's crucial here is understanding how this impacts the broader market and what lessons can be learned to prevent such situations in the future.
Right, Steve. The ripple effects of such a collapse can be far-reaching, affecting not only the investors involved, but also the perception of real estate investments in the region. It's a reminder of the importance of due diligence and the risks that can come with any investment, even those that seem secure.
Exactly, Sandy. For our listeners, it's a stark reminder to always verify the legitimacy of investment opportunities and to be cautious of offers that seem too good to be true. The real estate market is full of potential, but it's also important to be aware of the potential pitfalls.
Let's dive into the recent collapse of iPro Realty, one of Ontario's largest independent brokerages. This has left an $8 million shortfall in its trust accounts, which has put the Real Estate Council of Ontario, or RECO, under intense scrutiny. The scandal has raised crucial questions about the safety of deposits for buyers, sellers, and real estate agents alike.
That's right, Sandy. When suspicion falls on a regulator like RECO, which operates at arm's length with delegated authority from the government, there's immediate pressure on the minister to act. This isn't just a regulatory challenge, it's fundamentally a trust challenge. Once public trust is broken, other similar authorities in Ontario could find themselves under a similar microscope.
Exactly, Steve. The iPro scandal is more than just about one brokerage. It's a stress test for Ontario's entire delegated authority framework. After the media brought this issue to light, RECO announced a comprehensive audit, and the minister has broadened its scope to demand full transparency.
It's important to remember that these types of events tend to follow a familiar pattern. A scandal erupts, media amplifies it, and then pressure mounts on the government to respond decisively. The risk here is that in the rush to reassure the public, the government might overreact and introduce heavy-handed regulations that create additional red tape, which can be difficult to unwind later.
That's a valid concern, Steve. However, the minister has so far taken a measured approach, awaiting the outcome of a full independent audit before taking action. This is crucial because since the mid-1990s, when RECO and other bodies were created under the delegated authority model, public trust has sometimes been shaky, whether due to genuine failures, perception, or even political reasons.
Absolutely. And in the past, similar situations have led to reviews and recommendations, some aimed at a single regulator, others at the entire framework of delegated authorities. The key here is to balance the need for effective oversight with the flexibility and sector-specific knowledge that delegated authorities can provide.
Right. The advantages of Ontario's delegated model include operating at no cost to taxpayers and having a dedicated focus on their sector. This model allows each authority to be more flexible and efficient while bringing sector knowledge to the table. However, it's not without its critics, who point out potential vulnerabilities like reduced accountability to the government and the risk of being captured by the sector it regulates.
Critics do have a point, Sandy. Ontario's delegated regulators, like all regulators, have room for improvement, as recent reports from the Auditor General have shown. The good news is that these authorities can be self-correcting. The most successful ones respond to government priorities, focus on real risks, minimize red tape, and strengthen governance while keeping consumer interests front and center.
The iPro scandal serves as a reminder that the arm's-length model will face controversy from time to time. The minister is on the right path by gathering facts, grounding decisions in evidence, and acting with conviction where reform is needed. It's about preserving both independence and public trust in the long run. Let's turn our attention to the Greater Toronto Area housing market, which is still facing a cloudy outlook, despite some regional markets across Canada showing signs of improvement. The ongoing condo crisis in Toronto continues to weigh heavily on the overall market outlook.
That's right, Sandy. While sales in the Greater Toronto Area saw a 2.3% uptick in August compared to last year, they are still well below historical norms. Only 118 new condos were sold that month, indicating that the pre-construction space is still struggling.
It's been a perfect storm for the Toronto market over the past 18 months. Rising interest rates, appraisal issues, and a decline in investor demand have all played a role. Jordan Nanowski, the lead economist for the Toronto market at Canada Mortgage and Housing Corporation, also points to lower immigration as a contributing factor.
The federal government's decision to pause plans for population growth by lowering immigration targets has certainly impacted Toronto, a city that typically attracts a large percentage of new immigrants. This shift in policy has dampened what was once a strong housing demand.
Indeed, Steve. Toronto attracts around 30% of immigrants coming into Canada, which supported the strong housing demand we saw during the pandemic. With the change in immigration policy, that demand has slowed significantly.
Another factor at play is the trade war initiated by United States President Donald Trump, which has caused tariff turmoil affecting Ontario's industries. However, Nanowski highlights a silver lining. Toronto's economy is more diversified compared to other major Ontario markets, which might help it avoid a severe downturn.
That's an important point, Steve. Toronto's lesser dependency on goods exports to the United States, as shown by a Canadian Chamber of Commerce study, provides some insulation from these economic impacts. But regions like Oshawa and Alliston, which have automotive hubs, could be more vulnerable.
Despite this economic diversification, the severity of a trade war could still have substantial impacts. Prices in Toronto have been sliding, particularly in the condo sector, with the MLS Home Price Index composite benchmark falling by 5.2% in August compared to last year.
Prices may be dropping, but they're still high compared to other Canadian markets, keeping first-time buyers on the sidelines. However, rents are declining, which might give these buyers more room to save.
Nanowski points out that the trend of declining rents is likely to continue, with many units, especially rental apartments and condos, still under construction in the Greater Toronto Area. This increase in supply will likely put more downward pressure on rents.
Today, we're discussing a significant development in Kitchener, Ontario, where the government is taking bold steps to address Canada's housing challenges. The Honourable Bardish Chagger recently announced an investment of over $160 million through the Apartment Construction Loan Program to support the building of 398 new rental homes. This is part of a larger effort to make housing more affordable and accessible.
That's a substantial investment, Sandy. The project is located at 3243 King Street East and is being developed by Vive Development. It's the second tower in a three-phase development and promises to bring much-needed rental housing to the area. With a private road network and pedestrian walkways, it sounds like a well-thought-out plan.
Absolutely, Steve. The development also includes a two-level underground and structured parking facility, which is key in urban areas like Kitchener. The shared outdoor amenities and recreational space on the landscaped rooftop will provide residents with a sense of community and quality of life.
What's interesting here is the government's approach, utilizing the apartment construction loan program to provide low interest, fully repayable loans. This program aims to increase the rental housing supply for middle class Canadians while minimizing taxpayer costs. It's a strategic move to ensure a stable and sustainable housing sector.
Right, Steve. The program is part of the broader national housing strategy and is designed to support the construction of over 131,000 new rental homes across Canada by 2031. By providing financing solutions, the government is facilitating the creation of housing that meets the needs of various demographics, including students and seniors.
And it's not just about building homes, it's about creating opportunities for individuals and families in Kitchener to thrive. As Stephen Litt from Vive Development mentioned, this project is a shared commitment to supporting local workers and families. It's about building a community where people can live and grow.
Indeed, Steve. The completion of Phase 1 and the welcoming of new residents since August 2025 is a testament to the progress being made. It's a clear example of how collaboration between government and developers can lead to meaningful solutions that address housing shortages.
The extension of the apartment construction loan program to 2031 to 2032, as announced in Budget 2024, shows a long-term commitment to housing development. By removing minimum requirements for energy efficiency and accessibility, the program encourages developers to focus on increasing rental supply and achieving social outcomes.
It's a promising direction, Steve. As noted by CMHC, the goal is to promote stability and sustainability in Canada's housing finance system. By leveraging partnerships and innovative financing, the government aims to make housing more affordable and accessible for all Canadians. All right, Steve, let us dive into the latest development from our neighbors to the south. The United States Federal Reserve has just announced its first rate cut of 2025, a move that is causing quite a stir among Canadian mortgage professionals. This 25 basis point cut, bringing the federal funds rate to a range between 4% and 4.25%, is setting the stage for discussions on how the Bank of Canada might respond.
Absolutely, Sandy. This rate cut from the Federal Reserve, often referred to as a risk management cut by Fed Chair Jerome Powell, comes after a series of weaker than expected U.S. jobs reports and ongoing inflation concerns. It is a cautious step, not a panic move, which is important to note.
The implications for Canada are significant, given that the United States is our largest trading partner. A slowdown in the U.S. economy could lead to reduced demand for Canadian exports, potentially influencing the Bank of Canada's outlook and policy decisions.
Right. And while the Federal Reserve's actions do not directly dictate Canadian interest rates, there's often pressure on the Bank of Canada to keep pace to avoid currency volatility and capital outflows. If the US dollar weakens following a Fed cut, it could strengthen the Canadian dollar, which might reduce inflationary pressures here and give the Bank of Canada more room to maneuver.
It is interesting to hear from industry experts like Melissa Cohn, who believe that while more cuts may be on the horizon, the expectation of multiple cuts this year and next year is likely off the table. This suggests a cautious approach moving forward.
And Mike Fratantoni from the Mortgage Bankers Association echoes this sentiment by emphasizing that the Federal Reserve's projections suggest a couple more cuts in 2025 and another in 2026, with the expectation that the job market will remain soft, but inflation will not stray too far from the target.
So, as we look at Canadian policy, it is clear that while the Federal Reserve's moves can ease the path for the Bank of Canada, our economic fundamentals remain a key driver. Recent GDP data showing a modest growth of 0.2% in July indicates that the Bank of Canada might not feel an immediate urgency to cut rates.
Exactly, Sandy. Economists like Benjamin Reitzes from BMO suggest that despite some underlying softness, the Canadian economy continues to hold steady, which might not prompt an immediate rate cut. However, with below-trend growth and softer labor demand, as noted by Maria Solovieva from TD, there is still a case for easing.
As we approach the Bank of Canada's next rate decision at the end of October, all eyes will be on upcoming jobs and inflation data. For now, the Federal Reserve's recent move has certainly raised expectations that Canadian rates could head lower, but any action from the Bank of Canada is likely to be measured and cautious.
So, there you have it, folks. The interconnectedness of our economies means that decisions made south of the border can have a ripple effect here in Canada. As always, staying informed and understanding the broader economic context is crucial for making informed decisions in the real estate and mortgage markets. Sandy MacKay, thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.